Hello, everybody. I'm Kevin Chern, CEO of Sanguine Strategic Advisors. Welcome to this episode of MindShare, where we invite subject matter experts across a variety of business areas to educate you about challenges that business owners face every single day. Today, we've got Michael Green and Caleb Koch from Clearview Spend Solutions, who spend a lot of their time helping business owners figure out how to manage their cash flow and reduce expenses more effectively. Welcome to the show, Michael and Caleb.
Thank you.
Thank you.
So, before we get started, we're going to spend a second just getting to know you because our audience doesn't know who you are. But we do this little thing called who, what, why. So I'm going to ask you who you are, what you do, and why you do it. So, Michael, why don't we start with you? Who are you?
All right. Well, thanks for having us on here, Kevin. Really appreciate it. Of course, my name is Michael Green. I am originally from the Dallas-Fort Worth area. Over the last 10 years, have been traveling full time in my RV and traveling all over the country. So I'm currently posted up in sunny Florida and enjoying the warm weather.
So, Michael, what do you do?
What I do is I work with small and medium-sized businesses to help them uncover hidden cash flow within their businesses.
Okay, and why do you do it?
I do it because I get energy off of helping businesses and seeing them grow. I've started many small businesses and I understand that the challenges that they face, and it brings me energy to sit down with like-minded people and to talk about how I can help them boost their bottom line.
Fantastic. We're going to do the same thing with you, Caleb. So tell us who you are.
Yeah. Well, I'm born and raised in the Pacific Northwest. I live in Kirkland, Washington. Very avid outdoors person. I'm a pilot. I like to fly. Not what you think, though. It's not an airplane. It's a powered paraglider. And you kind of get to that place by, doing all of the other fast things that you would enjoy in life: snowboarding, motorcycles, outdoors. So, I mean, that's what recharges me to do the professional work that I do, which is banking. I've been in the financial world, whether it's fintech or actual banking, for really since 1999. My dad was a mortgage broker, and when I was a teenager, he showed me all the ropes there. And it's just evolved over time to get, an understanding of underwriting and sophistication of how systems work. And really, Clearview is a thing that Michael and I started, but it's a culmination of all those years of experience, having been in those systems, in those industries, and understanding that, there's a fundamental disadvantage that a small to medium-sized business owner has. And also, like, we realize that these banks and software systems, they're really a commodity. And so we're shedding light on the truth of how to pull the levers to get the outcomes that you want, that really can benefit the clients we serve.
Yeah, that's great. Well, it's a great segue into why we're here today, because, I think in our prior conversations, you guys have kind of mentioned to me that you see business owners talk about profit all the time, but very rarely do they actually sit there and talk about how money is actually leaving their company, right? They're focusing on how do I get profitable, but they're not examining, for instance, how they pay their bills, right? What's the difference? Like, how do we make the distinction, Michael, between profit and how you pay your bills, or how money is leaving the company?
Sure. I'll take this one. It's because cash flow isn't just about what comes in. It's about how long you can hold on to it before it goes out. And so every outgoing payment has a time, a method, and a cost. And if you think about it, most companies, or a lot of companies, they simply just hit pay now because that's what the vendor expects. And they think that they're doing the right thing. But the how determines your working capital, how much interest you can earn, and even your negotiating power. So when you shift payments from same day ACH to maybe a credit-based system with float or rebate, Now you're not changing your expenses, you're just changing your timing, and that timing is what turns cash flow into a profit tool.
Right. So it sounds to me like you're not actually going and say negotiating with one of your vendors to, cut the cost of your utility bill, for instance, but you're actually taking the cash and the way you're paying the bill is effectively reducing an expense that's kind of embedded in the way you're making the payment. So now you're focusing on the way the money is leaving the company, right? Is that down the right path there?
You're absolutely right. That's exactly it. So think of it as hidden margin. The smarter your money moves, the more it works for you before it leaves the account.
Great. Well, so you've mentioned that a lot of small, mid-sized businesses kind of are being quietly penalized by the way that the system is currently set up, right? And what do you mean by that exactly?
Caleb, you've experienced a lot of this when you were working for the bank.
Yeah, I'll take this. So there's this invisible hierarchy in financial systems that most business owners will never see. Banks, card networks, and credit card processors, they use spend volume and merchant category codes to classify risk. And some customers they get hit with higher fees, lower limits, or even lower rewards just because of how things are all coded. It's about perceived risk to the banks. And you see here, Kevin, the bigger issue isn't really about risk as much as it is about incentives to the banks. So think about the reps for the banks, right? Or the processors. They're all compensated based on spend volume and margin, not long-term client performance. And so extending more credit or teaching those business owners how to move money efficiently, it only happens if if there's potential for profits. So that needs to be present. And so those profits are driven by an ever-changing internal policy that the clients are never privy to. So if there's no commission in helping you to earn yield or improve liquidity, that conversation just never happens. And it's all about really whether whether the juice is worth the squeeze for the bank, right? The systems are designed to reward short-term profits, not long-term client success. And they're certainly never going to recommend a mix of services where the bank's profits are leaking out to their competitors.
Right. So, I mean, it sounds like, kind of paraphrase a little bit, they're selling a commodity. They've got not necessarily any incentive to make you more profitable or figure out ways on your behalf that you can be more efficient in using their product to your benefit. So they're not going to educate you about it. They're just going to let you keep on operating in the same way that you're accustomed to operating. And because you're not receiving that education about how to navigate or manipulate the system, as a small business owner, you're probably just going to keep doing it the way you were doing it. And what do they care? They're making the same amount of money either way. Is that a fair
Yeah,
assessment there?
it is. It is. See, everything is coded into the system. And because the people who are talking to you are representatives of the bank, the incentives for their behavior is really tied to that spend margin and transaction volume. So there's really no upside for a rep from a bank to tell a business owner about what the other options are. And that those other options are really going to help these small to medium sized businesses grow beyond their existing spending profile. Does that
Right.
make sense?
Yeah.
Yeah.
Well, I mean, let's get into the nitty-gritty of it, right? So, how are companies unknowingly leaving money on the table when it comes to accepting or making payments, for instance?
It really boils down to like three big traps. The first one is the interchange leakage. When businesses accept or make payments without optimizing the underlying transaction type, they'll end up paying unnecessary fees or they may leave rebate on the table. Second would be vendor misalignment. And what I mean by that is how you pay your vendors so that when you're making the payment, is it only benefiting the supplier and their bottom line versus benefiting both parties where the supplier and the buyer have a win in that transaction. So the third one is timing inefficiency. paying your bills too early or paying your bills in a very manual way, just because that's the way you've always done it. If you're doing things the old school way, you're losing both float and rebate opportunities. And so most companies think the cost of payments is fixed, but it's really not. It's completely negotiable, it's optimizable, and it's measurable.
So it's not just about the fees on the surface. It's also about how those fees are being structured and where the
Totally.
negotiation or optimization is even possible. Is that fair?
You got it. Yeah, I mean the system, the financial system is built to reward those people who understand it. And most businesses just don't realize that they can rewrite the rules in their favor. Maybe they will at some point in their, timeline, but primarily the small to medium-sized business owners are the ones that get overlooked and underserved. And that's what we're really here to fix.
Okay, so look, you both came from inside financial and software industries. Give me a practical example of something you've seen kind of behind the curtain that most business owners never even realize.
Yeah. Have you ever heard someone say, you'll have everything on one single pane of glass, one platform to rule them all? And most business owners get boxed into using just one bank, one card issuer, and one software platform because that's what their banker or their rep suggests. And it feels efficient, it feels good. But actually, it's designed to keep you inside their revenue stream. What they won't tell you is that using multiple banks and systems can actually make your business a lot stronger. And a single bank will rarely encourage that you spread your deposits around or use other credit lines across different institutions because that eats into their margins. But from a strategic standpoint, it is smart to do. You see, different banks have different underwriting appetites and different reward structures. The Small Business Administration, they have different lending relationships. And so when you diversify, you're going to increase your access to capital, you're going to improve your approval odds, you're going to reduce risk, and you're going to create leverage.
And on the technology side, the same principle applies. You don't have to use an all-in-one suite from the same brand. In fact, combining best-in-class tools from competing providers, it often yields better results. But the key here is integration. It's not uniform branding. And what most business owners don't realize is that the system isn't built for their optimization, it's built for institutional profitability.
Right. Big surprise there. Shocking. Uh, can you guys give me, Michael, can you give me an example of how kind of that insider understanding helps your clients make smarter decisions from a financial or technology standpoint?
Sure. We often find companies that have everything under one roof. Their banking, their cards, payroll, software, all tied to a single brand. And it looks streamlined, but in reality, it's limiting. And by separating functions and using a mix of platforms and banks, you can access more capital, you can qualify for better rates, you can increase your yield. And so we've seen businesses secure SBA funding through one bank while earning higher returns on deposits with another. And it's all about understanding how the incentives work and positioning yourself where each institution has to compete for your business rather than the other way around.
Great. So, if you could sit down with a business owner and audit just one area of their operations first, where would you start?
Payment flow. It's always about payment flow. I want to see who's getting paid, how often, what payment method are they using. That single view is going to tell me almost everything I need to know about a company's discipline, technology, and cash efficiency. From there, we can map out spending categories, credit card opportunities, and potential automation layers. Most inefficiencies, they're hiding in plain sight, like reoccurring vendor payments or outdated billing cycles or manual approvals. It's all really choking up their liquidity. And so fixing that first is going to create the momentum that we need to deliver measurable wins really in like 30 to 90 days.
Should
For
I?
example, we've got a client that they're spending about $100,000 a month, and they were looking to maximize the rebates that they're getting on the credit cards. They're currently using cards that are offering 2% cash back, which is a significant amount of money when you add that up each month over the course of the year. The challenge that this business was facing is that some of those vendors do not take credit cards. Even with a fee, they're not willing to accept those cards. Now, what a lot of businesses don't understand is that there is a way to convert that card swipe into a check or ACH. And so when you understand how that can be done, then what you can do is you can then take advantage of the card swipe using your card with a 2% rebate, paying the vendor in a way that they want to be paid. So they're still getting that ACH or that check. And then you do pay a small conversion fee to do that. But when you factor in the tax savings and the rebate and the float and how much you're earning on that float, the value of that payment, it can be pretty significant. And so often vendors say, "Oh, you don't take a credit card," and then all of a sudden the buyer is like, "Oh, well, that that's unfortunate," and then they move on and they write a check. Well, that's a scenario where that money's not working for them, and that's where we can teach people how to leverage those tools to positively impact their bottom line.
That's great. I mean,
And
and that one nugget, right? That's something that could literally generate 5 or 6 figures of savings annually in your business. But that's what we're talking about. The most business owners, small business owners, everyday business owners have never received that level of education about the mechanics of how that works, really to be able and don't understand how to implement something like that, but it can be meaningful to them,
yeah,
correct?
100%. 100%. Yep.
absolutely meaningful. And you know, we're bringing people to the source. You know, we're leading them to the water, really. And you know, to get even more tactical, I'll tell you this. With the vendors that you're working with, now that you just heard what Michael said, and that there's a lot of benefit that you can receive from using the strategies that we recommend. Your vendor is still going to be getting paid the same way they always have, and then we'll give you the scripts, we'll give you the words to use to talk to your vendor to then create time, so that when you're making your payment, the timing of that payment could create a little extra benefit. We'll tell you literally what to say to them to get what you want. And then we'll also look at the vendors that you're working with to help you to prioritize where does it, you know, make sense to lean in, and where does it like not make sense and just kind of like let it go.
Right.
And it's that hand holding approach. It's that we're literally sitting there with you looking at the same piece of paper, which makes it, you know, someone that you can trust. Like they're, you know, that's your friend. You got a cell
Right.
phone number. You call them
Well,
up.
I mean, yeah, and you know what I gather from this is knowledge is your friend, right? And it's the lack of knowledge, the lack of education about the way that the mechanics of these interactions, these transactions happen, that really is stopping people from benefiting. Now, Michael, you alluded briefly to the subject of tax, right? So a lot of entrepreneurs assume that tax strategy is separate from how they spend. But that's not entirely true, is that?
Well, yes, not at all. Okay, so the way money moves directly affects the tax treatment of that money. So rebates, rewards, even credit card incentives, they can all have tax implications, and depending how they're classified makes a big difference. You know, many companies are treating these rebates not as non-taxable when they should be reducing their expenses, or vice versa. So the same goes for fees. Some can be deductible, others can be capitalized, and really the key is alignment between your spending strategy, your account, like how you do your accounting, and tax planning. But most business owners, are never going to connect the dots because their CPA and their banker and their AP person, they're not talking to each other.
Right. So I think what I'm taking from this is actually the way that a company pays their bills or earns rebates associated with the way that they'll pay the bills can actually influence your tax position and also compliance exposure, correct?
That, yeah, exactly. Like Caleb said, when it's done right, it's a compliance advantage, but done wrong, it's an audit risk or money left on the table.
Right. So for instance, like I sense like a rebate is not always going to be considered a taxable income to you. correct?
That is correct. A rebate is considered a discount at the point of sale, and if you read the tax code, it basically says that that's not considered a taxable income. And so there are some strategies that you could deploy that could put some money into your pocket without you having to, claim it as income.
Right. Okay, so we talked about actually stripping out some expenses. We talked about positive tax impacts based on the way that you're managing money, which I think people have a general idea that the way you pay your bills can have an impact on your tax. How about the impact on credit and building credit, using credit? What's the biggest misconception that business owners have about credit limits or liability?
I think the biggest misconception is that credit equals debt. It doesn't. It's liquidity. And when used strategically, it's one of the most powerful tools that a business can have. But getting approved for the right credit line is a lot harder than people realize. You know, the underwriting is all risk driven, and something as small as your business address not matching up to the Secretary of State record, or an inconsistent phone number, or even your IP address, they can all trigger a decline or a fraud review. And the stated monthly spend limit, when you're filling out your application, that is going to directly impact your spending power. And that's why credit coaching matters. It's about preparing your business to look fundable through the lens of the underwriter.
Yeah, Kevin, and another myth is that you should rely on one bank or card issuer. I think I talked about this earlier. Banks aren't designed to help you diversify, and they want exclusivity because, bottom line, is more profit for them. But you're far better off building relationships with multiple institutions because it increases your spending power, it improves your negotiating position. Think of it like building a portfolio, different banks, different benefits. You also have more resilience. You've got backup cards. Speaking of backup cards, Caleb, you tell us about the client that we were working with that had the DoorDash issue.
Right, right. All right. So I was working with this staffing company, and they had like a $250,000 line of credit, and they would use all of it, that credit each month, and then they pay it down to zero before the statement cycle ends. But here's the thing: the primary card holder, he was the owner of the business, and that credit account was being managed by the CFO, and the employees were the ones out there spending the money. So one day, this group of employees were out in the field and they ordered lunch using DoorDash for their delivery service. And while they were, putting in the information and DoorDash was processing that payment, one of the employees had punched in the wrong billing zip code. Simple mistake, right? DoorDash attempts to process the payment, boom, declined. It's an automated system. Second decline, third time, boom. Now the bank has shut down the entire account because it appears that there's a fraud attack that's happening, and the whole line of credit for everyone, it's frozen. Um, this becomes a big problem because the only way to remove that fraud hold on the account is for the primary card holder to make the call. That means they're sitting on the automated system, waiting in line. Then they're talking to that person in another country who's reading from a script to walk them through for your safety precautions. And it is very slow. It is very painful. And I'll tell you what, it was a horrible customer experience. And that client at the time, they were ready to just throw the baby out with the bathwater. It didn't matter what the rebate was. They were not happy. And so all of that could have been avoided had that business owner diversified and had a backup in
Yeah.
their wallet. But because their sales rep convinced them that that wasn't the right way to go, they had all their eggs in one basket, and it's ugly when it doesn't go right.
So, guys, a lot of business owners, what I see, especially in small business world, is they tie their personal credit to business operations. Um, is there a smarter way to structure that relationship? I hear people say, "Oh, I've got this line of credit, this business line of credit," but it's actually it's a line of credit that's got their personal assets tied to it. They're personally guaranteed to it. So really what they have is a personal line of credit secured by their business and their personal assets. So is there a better way to do this?
Yeah, there is. Personal is where it starts, right? Personal credit's where you're doing everything, picking it up from your bootstraps. You got it tied to your home, your HELOC, or whatever. Again, that's where it starts. But where you want to grow and graduate into is business credit, or commonly referred to as corporate liability. That doesn't happen until you've at least, got 2 years of good financials under your belt. But corporate liability is really the next step in funding your operation. Keeping them separate gives you leverage, and truly, both are valuable. Even if you can just do credit, per corporate credit, like there's still some real value in having both in your arsenal. So once you understand really how the lenders are evaluating those applications, what data they pulled, what triggers automatic decline, or like the specific timing for submitting your application, that matters actually a lot. You can stack the approval odds in your favor. And it's not just about access to credit, it's about controlling the process so that you never get boxed out by small technicality.
Okay. And when companies start optimizing their spend processes, what kind of operational and financial changes do they typically experience?
Well, the first change is clarity, real-time visibility into where money is actually going. Then comes control, automated workflows that eliminate the bottlenecks and late fees, and then finally yield, using credit float and rewards to convert spend into revenue. So over time, those layers compound. And of course, teams will spend less time chasing receipts or approvals. The cash flow tends to steady, and then the organization starts thinking strategically about how every dollar moves through the organization. So it's not just savings, it's control, it's confidence, it's, knowing that you're moving
Yeah.
money strategically.
And that usually starts with visibility, not just putting in a new piece of technology, right?
Exactly. Technology without visibility just automates the chaos. So the transformation starts when people can finally see what's happening under the hood.
Yeah. And so, I guess, where do you start, right? For a business that wants to become more efficient with how money moves around their company, where do they start? Like, I think that's the biggest challenge that business owners face is kind of like paralysis because they're just not know, they don't know how to start the process, right?
Right.
Yeah. Yeah. I mean, paralysis by analysis is a fate that so many people fall victim to, and the answer is this: it starts with data. So let's run a 30-day snapshot on all of your outgoing payments. How many vendors? How much are you paying? What's your payment method? How early do you pay? And what card opportunities exist? That one exercise is going to expose all the inefficiencies, and it's going to give us the foundation for building a smarter capital strategy for your business. So once you can see how the money moves, then you can start aligning it with your credit and banking relationships. And the reality is a business with an optimized spend operation, they look a lot stronger on paper to lenders. A clean payment process, controlling your cash flow, uh, accurate vendor data. It's going to improve your risk profile to both the banks and the Small Business Administration if we go down that path to get funding. And that's really is that's really what will open up the doors for better loan terms and higher credit approvals.
So it sounds like that there is a clear first step that companies can take even before you go out and spend money hiring someone to execute solutions. Really, it's just about proving out the value, right? Even before you start like doing a deep dive in.
Exactly. The numbers are going to tell the story. Numbers don't lie. When you understand your payment flow and you're not just tightening your operations, you're building the financial credibility of your operation, and that's what's going to unlock, expand, and grow into new opportunities.
Yeah. It sounds like there, in order for you to really embrace this, there has to be at least a little bit of a mindset shift in managing spend in a company, right?
Oh yeah. Yeah. First, stop seeing spend as a cost center and start viewing it more as a performance system.
Right. Every dollar that leaves your company should either buy value, create time, or earn yield. And once you adopt that mindset, your financial decisions become proactive instead of being reactive. And you stop chasing savings and start engineering outcomes.
And that's how modern companies grow, not by cutting costs alone, but by making every transaction pull its weight.
Very good. Well, guys, really appreciate you educating everybody about this really important topic. But before we go, I just want to give you a minute to tell our audience a little bit about, how can Clearview Spend Solutions help small business owners on this journey and help them kind of start that process?
We'll offer you our time, and it starts by you setting an appointment on our calendar to talk. It's not going to take a lot of time to understand where your business is, and then we'll help you to reframe about where it could be. But it just starts with having a conversation, and we'll do an analysis on your business. And then we'll apply the strategies that can help you grow and expand and really uncover a lot of these hidden profits that are already existing within your spending habits.
Yeah, and Kevin, we have a calculator that we built to help our clients determine what and how much they're leaving on the table. And we'll sit down and talk about how much are you leaving on the table and how much can we help you capture? And we're so confident in our ability to drive meaningful results that we offer for qualified clients a satisfaction guarantee. It's not even a performance guarantee, it's just satisfaction. And we're so confident that you'll be satisfied with the results that you get that we're willing to put it in writing and back it up with that guarantee.
Doesn't sound like a bad deal.
Take
Well,
all risk off the table.
absolutely. Well, Michael and Caleb, once again, I really appreciate you sharing all of your insights with our audience today. As you know, business owners struggle with cash flow optimization every single day, and they just don't know how to start attacking it. So, really appreciate you contributing your time and your thoughts on it. And thank you to our audience today for attending MindShare, where we try and help you solve some of business's most pressing challenges. Until next time, take care, and we'll see you soon.